Good morning, guys, and welcome to the webinar series for the Financial Freedom Podcast. I'm really delighted to have Lon Welsh from Ironton Capital back on. He was previously a sponsored guest, and then he also did one webinar back in early 2025 with national trends. And today he's going to give a trends update for August 2025. I'm really excited to hear what he has to offer, especially given what's going on in the market, in the economy, so Lon, welcome.
Thank you so much for having me. It's very exciting to be back.
Yeah. Yeah. And briefly introduce yourself for the new audience and we'll dive into your presentation.
Yeah, I've been investing in commercial real estate for a little over 20 years, and I've built a real estate brokerage to be the largest independent in Colorado, about 750 brokers. And I currently run a private equity fund called Ironton Capital. Ironton Capital, so I can help people invest passively in real estate. We really help a lot of people who are tired of being landlords in a tax-free and tax-efficient way to get off the treadmill and get their life back.
Yeah. Yeah. And I know exactly how I started my career out as a landlord. And these days I just don't have the time or the patience for it anymore. I'm really excited to delve into what you have and excited to learn more for the audience.
Absolutely.
Yeah.
What I'll do is I'll go through some of the highlights of our trends package here, and I'll have my colleague send you a copy of all the slides, Dr. Lou. So if you've got some of your viewers that want a copy of the slides, we're very happy to share those with you guys.
Yeah.
Kick ahead a little bit here. The probably most important thing to understand about what's driving our overall real estate market, and to a lesser extent the entire economy, is revolves around consumers. The University of Michigan does a study on a pretty frequent basis asking consumers how do they feel, and you can see that in early 2025, expectations and sentiment fell off a cliff. Some of that is driven by the news of tariffs raising the specter of inflation. I think there's also some concerns there might be more unemployment in the future, so it might be tougher to have a job. And what you tend to find is if you feel negative about this, it's very difficult to get excited about buying a house, buying a car, buying a new washing machine, and people just tend to pull back and hold on to a lot of their savings. This is a big driver of what we're seeing across the entire real estate market. If you ask consumers more specifically about house buying intention, if you ask, is it a good time to sell? About half the people think that it is, which is off a high of in the 80% range just a couple of years back. But the good time to buy, you can see that we've gone from around 70% to under 20%. So you probably have seen some headlines about how the number of homes being purchased has really fallen quite a bit. We're at like about a 20-year low for home sales transactions. And this is the core driver. It's a lack of confidence in the economy, plus the high interest rates leading to people feeling it's not a good time to buy. So they're just going to put everything on hold for a little while. I suspect that once we get past some of the tariff confusion in the headlines, that seems to be the biggest driver of this, and that'll lead to an uptick in enthusiasm about let's go buy or sell a house. And it'll probably also lead to an uptick in enthusiasm for people to invest in real estate because that's been very slow lately as well. So the good news is if you ask people, do you feel like the economy is strong? Almost half of them say yes, and it's up dramatically over just the last couple months. So there's some sort of a disconnect between feeling that the economy is good and feeling like my personal situation is good. My guess, when I've watched this for a very long time, it's very interesting seeing the psychology of consumers is once they start feeling like, how is the economy doing? And the reality is that inflation is very attractive. It's under 3%. And if you look at the unemployment rate, it's at about 4%. So both of our big macro indicators are doing well. Like a lot of things are going very well in the economy. Most of the impact of the tariffs so far is being absorbed by companies taking a little bit less margin on their products, or they were able to order a lot of inventory to fill up their warehouses at the old prices before the tariffs went into effect. So hopefully we'll see these tariffs wind up before that changes. So for those of you guys who work with renters because you're a landlord or you like to invest in apartments, there's just nothing but good news for you over the next 5 years. So a lot of renters are struggling to pay their bills. If you take a look at this chart on the left on the bottom, you can see that about 25, 28% of all rental households are behind on at least one of their bills. So what this means is that it's very difficult for people who are renters to save up any money at all just for emergency reserves, let alone amass a down payment to go buy a house someday, which means they're probably going to be renters for longer than historically they have been. And you can see some early evidence of this trend on the right-hand side of this. FRED is the Federal Reserve Economic Database, and one of the things they like to track is what percentage of the households in America own versus rent. And that's what this purple line shows us. And you can see that the percentage of people that are homeowners has declined a little bit over the last couple of years, and that's probably a trend that's likely to continue. This means there'll be more renters for a longer period of time. So whether you're a smaller landlord with a 4-unit apartment complex, or maybe you've got a 20-unit apartment, or maybe you're a fractional investor in a 300-unit community, this is all good news for us. And that's primarily what we like to invest in on behalf of our investors as well, as we like the long-term dynamics there. Interestingly, one of the things that we're seeing for consumer behavior is that inflation has made it a little bit more difficult for people to make ends meet. So the logical response would be to spend less and give up a few things, but people aren't giving up on their lifestyle. What they're doing is spending more on their credit cards or buy now, pay later. So you can see the credit card debt has gone from about 250 billion to just over $1 trillion over the last 24 years. So that's just one more headwind, primarily concentrated on the rental households, that they're not going to become buyers anytime soon. If you take a look at how current are people on their debt, what you find from a first-time buyer standpoint is that student loan debt is the biggest anchor that people tend to be getting behind on. And this also tends to be a set of people that, normally speaking, would be moving into the first-time buyer realm. But the fact that they're delinquent on their student loans probably means they won't have the credit score to be able to do that.
It was interesting because one thing you can see is you hear all this, you hear on the just talk is there going to be a recession and with interest rates, and then you go to the airport and it's booming. Or you go to restaurants and I'm asking myself, what recession? But it's
None.
and it's interesting because it sounds like a lot of people are getting priced out, and it's almost like real estate is where only the wealthy can afford it. But interesting to hear more.
Yeah, I think increasingly among the first-time buyer community, it's going to be seen as like a privilege or like a really almost rare thing to be able to go on to afford to be able to buy your house, which is a little bit sad, but for investors, it's fantastic. It's interesting because when you take a look at the average net worth of an American household that rents, it's about 10,000. And for the people that own, it's about 400,000. Owning your real estate, even if it's only your own single-family house or condo that you live in, is the most proven path to wealth building in our country, and it has always been that way. Okay, are prices for homes going to drop? The quick answer is not very much, if at all. So the chart on the upper left just shows us the green line is the number of active sellers in the market, and the blue line is the number of active buyers. And you can see for quite a lot of time that there's been a pretty good linkage between supply and demand, which led to stable or slightly increasing prices during 2020, after the initial COVID panic, through all of 21 and the first part of 22. The mortgage rates were very low, 3% or less, and we had an incredible boom for home prices. And you could see the blue line during that period that's the buyers, was very high, and there was very few sellers. So it was no surprise, with supply and demand being so out of balance, that prices went up very dramatically during that 18-month period. Now that things have changed because interest rates have gone up a bunch and buyers are very pessimistic, as we earlier discussed, there's a lot of people who want to sell, not a lot of people that want to buy. So we would predict that home prices will be soft to slightly declining probably over the next 18 months. I think you're going to see really a tale of two markets, in that, at least in the Denver market, we're seeing that home traffic is still relatively okay and that prices are roughly stable. But the condo market is very soft, and that's because it's primarily built on first-time buyers, which are not really participating, and investors who are a little bit skittish right now. So we're seeing that condo prices in a lot of markets across the U.S. are declining at a very soft rate. I don't think it's going to be anything catastrophic, but it's certainly not a time for appreciation with homes. Where will you most notice effect? In the South and the West is where you've got the supply-demand imbalance, and that's probably where you'll see the most pricing softness. What we have seen in the Northeast and the Midwest, for your listeners in those geographies, is that there wasn't as much of a run-up of prices during the post-COVID, explosion that we had. So there's less of a correction now. More of that post-COVID excitement was in the South and West, and they're having more of a hangover now to pay as a result of that. Where you're at in the country will definitely have a big impact in how you experience this soft period in real estate. Overall, inventory is down about 13% for the number of homes on the market compared to just before COVID, but it really varies a lot. The red circles here are worse if you're a seller. So you can see Arizona, Texas, Colorado, Washington, and Florida are the places where the inventory is up the most. The green circles are the places that's better if you're a seller. New York, Wisconsin, West Virginia, Illinois. There's definitely a clear geographic division on how this is working out right now. This would be roughly true for apartments as well. So if you are in one of the states that has a shortage of inventory for houses, there's probably also going to be a little bit of a shortage of apartment buildings, which means that they'll probably be a little bit better from a seller standpoint if you have a rental property that you want to sell. Home prices, I'll send this chart out along with the entire pack to Dr. Liz so he can share it with all of you guys so you can take the time to look up your market. Denver's prices are down just a little bit year over year, but you can see it's about half and half. Cleveland, Ohio, unlikely candidate, is on the top of the list. Overall prices are expected to go up about 2% this year. And I think that's probably just about right. I think you're pretty close to that. Are we going to be in trouble for the overall market having a repeat of the 2008 housing crash? And the answer is probably not. So I'll show you why that is. The chart on the left shows you the amount of equity in all the homes in America. And right now it's a little bit over $30 trillion. And the composite debt on all the mortgages for those homes across America is the red line on the bottom. That's about 12 or 13 trillion. So we've got about 17 trillion of equity overall across America. It's a record high amount of home equity. If you think about our last big problem that we had in the housing market, it was we had a peak in 2007. Nationwide, the prices dropped about 20%, 25% between 2007 and 2010. They bottomed out, and then we've had a really good rise ever since. Why did the prices drop 25% in 2008 and 9? Well, the answer is, if you take a look at this chart, you can see that collectively as a country, the homes were not worth as much as the debt. So many homes were underwater, or to say the debt was more than the value during the 2008, 9, 10 financial crisis. And that's why the home prices dropped so much. Here we have nothing at all like that. We have loads and loads of equity. Interestingly, 39% of homes are owned without any mortgage whatsoever. Another third of homes have less than 50% loan to value. There's not a lot of people who even have a 50% mortgage. It's a very healthy market on the real estate side. One question I'm frequently asked is, are we going to have a recession or not? And the economists seem to think, from what I read in the Wall Street Journal, that we're not likely to have a recession this year, but there's some chance, maybe a third, 40% of having a recession next year. So then you might wonder what historically has happened to mortgage rates during a recession. And if you take a look on the left-hand side, you can see the average home price in America generally has gone up during recessions. The principal exception to that is 2008, when the great housing crash is the thing that caused the recession. So no surprise, that's the one outlier there. You might also be curious, what happens to mortgage rates during a recession? And the answer is, on average, they go down somewhere around 2%. The last 3 recessions, the drop has been about 1%. And I would expect that would probably be our case as well. I don't expect rates to go down really any material amount until we have a recession, but you could see a half point to a full point drop, historically speaking, if we see a repeat of history for that. So we talked about the mortgage rates. Let's talk very briefly about why mortgage rates are as high as they are and why I don't think the mortgage rates are likely to go down a whole lot anytime soon. So on the upper chart here, the Federal Reserve Economic Database will show you what the average mortgage rate has been since 1970. So historically speaking, these rates that we've got right now, they're just a little bit below 7%, are historically right about average. There's nothing wrong. And you can see that there's been decades where the mortgage rate's been above 7%, and yet we sold millions of homes every year when those rates were above 7. So by no means is this a death knell that we can't sell real estate in a market like this. So it's only painful with the mortgage rates right now when you take a look at 2020, 2021, and the first part of 22, where you see the average mortgage rate was like 3%. 7% feels like a lot compared to that. It's like getting off the interstate. You've been driving 80 miles an hour. Now you're driving 35. Oh my God, this is so slow. We're just going through that mental transition right now. So there's two components to the 30-year rate. There's not very much correlation between the short-term rate, which is the lever that the Federal Reserve is directly able to control. And this is the one that's in the headlines all the time. Is Jerome Powell going to cut rates at the next Federal Reserve meeting? The short-term rate isn't really the thing to watch. What tends to set the mortgage rates is actually the 10-year Treasury bill. So when the U.S. government runs a deficit, they have a variety of debt instruments they can use to raise money. The 10-year Treasury, a 10-year borrowing on the part of the government, is the most popular way for them to raise debt. And the way the mortgages are priced is you take the 10-year Treasury plus a risk premium, and that's what you pay for your mortgage rate. So you can see that the 10-year rate is currently at 4.4%. And that's about where we were in 2003, 2006. And it's up quite a bit from where we were, say, in 2020 and 2021. So I think it's unlikely that the 10-year rate's going to go down anytime soon. And there's really three big drivers for that. The first is the new tax package that Congress just passed is going to greatly increase the amount of the deficit spending over the lifetime of the spending package. And since we have to borrow more money from people, generally speaking, overseas, we have to offer a higher interest rate to attract all that money to fund our deficits. That's really the biggest driver. The second is investors want a higher reward or a higher interest rate for more risk. As we have more debt, there's more risk of a default that we won't be able to pay all this debt back. And actually, the credit agencies that rate government debt downgraded the quality of U.S. debt about a year ago. Canada has a higher credit rating on their debt than we do. Interesting. So now that our rating is lower, we have to pay a higher rate. And then the third is inflation expectations. We talked earlier about how inflation's under control. So that's not a very big factor. It's really the first two. But understanding that the 10-year rate is unlikely to go down means that there's a floor to our mortgage rates is unlikely to change very much. So that's the first factor. The second factor is called the risk premium. We just talked about how the 10-year Treasury is about 4.4%. You might be able to borrow at something like 6.7% or something like that. So the risk premium is about 2.3%. What drives the risk premium? A really big factor is the Federal Reserve during the COVID panic of, say, April and May of 2020 flooded the economy with lots of cash so that we wouldn't have a financial crisis. And that was definitely the right thing to do at that moment to bring certainty and confidence in the financial system. One of the ways that they did this is they bought a lot of mortgage-backed securities, MBS. So the way for you to think about a mortgage-backed security is if a loan officer originates 100 different loans on houses that are very similar, they can rubber band these loans together and they cut them into slices called tranches, and then they sell these debt instruments on Wall Street, and that's called a mortgage-backed security. And then the mortgage broker gets paid back the cash for those 100 loans, and you can go out and make 100 more mortgages. So that's how our mortgage system actually works. So what the Federal Reserve did is they flooded a lot of cash into the mortgage-backed security market, and they bought literally trillions of dollars of mortgage-backed securities as a response to the COVID stress that was in the market. It was $2.7 trillion that they purchased. So as a result of this absolutely extraordinary and unprecedented demand, the mortgage rates went down. You could see that the rates, I'll actually show you. Right before COVID, we had our panic. The mortgage rates were about 5%, and the mortgage rates dropped to about 3% right after COVID because of the Federal Reserve buying all these mortgage-backed securities. So once they stopped buying the mortgage-backed securities, the rates went from about 3% to 7% in the course of 6 or 8 months, really quick. But that's the big driver why we had that stimulus to the economy at the super duper low interest rates. So the Fed has stopped buying these mortgage-backed securities, and they've sold a very small number. So they've gone from 2.7 trillion of securities down to 2.1 trillion. But there's a huge perception of risk in the market in that if the Fed continues to sell off these securities, someone has to buy them. And then we also have to have someone buy all the new mortgage-backed securities that get built every single day as we finance all the home transactions that are taking place in the market. So it's expected it's going to take 7 or 8 years for the Fed to get rid of all these mortgage-backed securities on their balance sheet. And for that time period, it's very likely the risk rating is going to stay a lot higher than normal. So when you hear about economists talking about rates are going to go to 5.5% or 6%, I haven't been able to find any economic evidence providing any backstop to why the rates would go down much, other than the rates go down during a recession. We talked about that. I don't see the path to that. Historically speaking, the rates are pretty attractive. Long term, average rate 7.75%. We're floating at 6.7, so we're about a point below the 50-year average. Overall, not bad. Here's a great quote. So in 1971, the average mortgage rate was 7.3%. And if you said that's too high, I'm not going to pay that, I'm going to wait for the rates to go down, you would have waited 22 years before the rates got below 7.3%. But the values of real estate on average across America quadrupled during that time period. Don't let the rates hold you back. I want to talk a little bit about multifamily with you guys. So this chart shows you which areas, so this is on a county level, have a really strong shortage of housing. Red is a huge shortage of housing. Green areas, there's an adequate supply. So there's quite a few states that really need more housing, both on the rental side as well as on the for sale side. So the US is structurally short of housing. If you take a look at the number of housing units that we've built for people to live in per 1,000 people, you can see that America has built about 420 houses per 1,000 from 2016 to 2018. And you can see it compared to all these other industrialized countries, we've actually done less construction than anybody else. So it's not a really particular surprise that we're a little bit short of housing. What's happened to commercial real estate prices in the post-COVID era? And the quick answer is that apartment prices are off about 20 to 22% from their peak, and apartments are generally trading at where they were at the end of 2020 or the first part of 2021. You can see some other asset classes there, how they've generally performed. If you take a look at the great financial crisis, about a 30% correction in that market. So this hasn't been as severe a correction as 2008, but it has been a pretty good buying opportunity for us, that's for sure. So there's been a lot of new construction. I'm going to talk about that in a couple slides, but I first want to talk about the demand side. This shows you a chart of absorption of apartment units that are vacant from 2000 to current. So you've got about 25 years of data here. And absorption just means I've got a new rental household and they're going to take a unit that is otherwise vacant in an apartment building. They're going to sign a lease and they're going to start making the payments on that lease. So we've absorbed one unit of vacant capacity. And you can see over the last 12 months, we've had an absolutely gangbusters amount of new apartment demand. And I cannot believe how many apartment units that we were able to fill. Depending on who you ask, it's somewhere between 670,000 and 720,000 vacant units got filled in 2024. It was absolutely fantastic. The first quarter of 2025 was also fantastic, and I should have this. When we talked earlier about the inflation rate being low, unemployment being very low, pretty much everybody who can get a job, who is employable, has a job. Many of those people can't afford to buy a house. So what do? They're all renting apartments. So this is that tailwind pushing the entire rental market. So that's demand. Let's talk about supply. You can see this is the number of new apartment units getting delivered into the market from 1968 to current. So you can see we've been absolutely on a gangbusters tear for delivering rental units in 2024 and 25. But you can see that it's falling off quite a bit. So why is the curve shaped like this? During 2020, the Fed slashed interest rates to next to zero. So not only were mortgage rates for home buyers really cheap, apartment construction financing and apartment purchase financing was also near all-time cheapest rates ever. The other thing that was really different is that there was a change in the attitude of commercial underwriters at the bank saying, we're willing to give you a higher loan to value loan than we ordinarily would. So these two factors combined to the uptick in rents led to a very favorable environment for a real estate developer to go to a bank saying, I want to borrow a bunch of money, build a new apartment complex. And the bank said, let's do it. Here's a wheelbarrow full of money. Let's go get started. And they all started at about the same time. 2020 and the very first part of 2021. So it's no surprise all those things came to delivery in 2024, 25, and the first part of 26, because it takes 3 or 4 years to build an apartment complex from scratch. So it's not a mystery how much new supply is getting added, because you can see all this stuff with a 3-year view. Last year was the record. This year is going to be a lot less new supply getting delivered, and 27, 28 will be even less yet. We believe that, I'm going to go back to demand, that this amazing demand is going to get a little softer if we have a recession, but not a lot. And if we don't have a recession, I think that demand is going to continue to be really strong. Why? Because I don't think mortgage rates for buying a house are going to go down anytime soon, and I don't think home prices are going to go down very much. So if that's the case, any growth we have in the population means that's almost all going to land in rental. And taking a look at the supply side, I can tell you that the amount of new rental inventory being delivered is going to be less than half of what it was. What does that mean for vacancy rates? It means they're going to drop. What does that mean? A couple years. So we've got these tremendous tailwinds that are going to push the entire rental market. So whether you own a duplex or a 20 unit, or you're a part investor with us in a couple thousand units, we are coming up on some very good times to be in the multifamily space. Well, spend a little more time on that. So the number of new deliveries is falling off a cliff, and the gap between supply and demand is inverted. So we're at a situation where we're delivering more units than we had demand, and now we're on the other side where we're not delivering enough units to keep pace with demand. Meanwhile, the banks are not very excited about doing a lot of lending. So there's not a lot of new construction getting started today, which means we've got at least a 3-year run, at least 2028, if not 2029, before we see any material uptick in new construction deliveries. So it's a very good window there. You would expect, if that's the case, that the number of people finishing off their lease saying, yes, I want to stay and I'm going to sign another lease, should be increasing. And generally speaking, that is true. We're seeing that the growth in rental households has been very strong. You can see recently we've been creating around 600,000 or 700,000. This is per quarter? Yeah. So that the number of new rental households is higher than it has been since 2015. So the biggest driver of this is young adults, age 18 to 24 years old, who are living in their parents' house, finally got a job or graduated from college and said, I'm going to get my first apartment. That's our biggest driver of all this tsunami of demand. Interestingly, what percentage of all the 25 to 34-year-olds still live with their parents? The answer is 15, 16%. Historically, that's near the very high end of the range. So what should happen over the next couple of years is that we should see a lot of these people find jobs and then get out of their parents' house and rent their first place. So the percentage that should be living with their parents should be closer to 13 or 14%. We're at 16%. That's just about 1 million more units of residential rental demand that we have not tapped yet. So there's just a huge demographic push because there's a huge number of kids in this age bracket. Very good demographics propelling the apartment market for several more years at least. So since absorption has been so strong, the people that own apartment buildings have had to give less concessions when they finish a new building to attract tenants to fill the building than they have in prior market cycles. You can see across all of American rental apartments, only 15% of them right now are giving out concessions. If you compare that to our two previous economic cycles, 40%, 28%, this has led to much healthier profit margins for the owners of apartment buildings this economic cycle. And that's because of that really robust demand. And we don't expect that to change a whole lot here. So I think that is most of the key messages. The barrier is it's hard to buy a house. If you can't buy a house, that means you got to stay a renter. And that's all really good news for us. Oh, I should talk about this. So one more headwind of why people can't save any money for their down payment is the tremendous amount of student debt and consumer debt. If you take a look at this chart, you can see all consumer debt is $18 trillion. And just as recently as 2013, it was about 11 trillion. So we've had over $7 trillion of consumer debt in the last 12 years. it's going to be tough for people to dig out of that hole, which means they're not going to be saving money. Multifamily is the way to go. And I think that's the main stuff that we want to talk about today.
I know you have a book coming out, and also direct the listeners and viewers to the slides. And how can people connect with you and learn more about these? We're doing these webinars almost quarterly now, and how can they reach out to you?
Yeah, so what I'll do is I'll put my contact information here in the chat box, and I'll give it to you as well. So my cell is 303-619-0633. I was lucky enough to have a lot of people mentor me when I started my investing journey, and I am not too busy to spend 15 minutes on the phone with you guys. Just pick a time, and I'll spend 15 minutes talking about your investing plans to try to give you some direction. I'm very happy to return the favor that was given to me when I got started. 303-619-0633, or you can reach my email at Lon Welsh, LonWelsh, at Ironton Capital, IRONTON, irontoncapital.com. I wrote a book last year on diversified passive real estate investing. So if that's of interest to you, so you're not entirely in the stock market, just to not have all your eggs in one basket, or maybe you're an active landlord and you're a little bit tired of working with tenants, you'd like to have the benefits of real estate without the headaches, we can help you with that. So you can go to irontoncapital.com/financial freedom, and then you can download a copy of our book for free. And that's a great resource that will answer a lot of questions for you.
Excellent. I really enjoyed this presentation, and the audience and listeners, viewers, and really great value. All of Lon's resources will be in the links and show notes. Be sure to give him a follow. And thanks so much for this wonderful webinar.